Major funding for these programs is provided by grants from Capital One Bank and Perfect Building Maintenance, Murray Hill Properties, SJP Properties, Cushman & Wakefield, Greenberg Traurig, LLP, New York Community Bank, Bank of America, Kilroy Metal Products, New York's Window Company. Additional funding is provided by Akron Gold Brothers, LLC, Briarwood Organization, C.B. Richard Ellis, City Investment Fund, Essex Capital Partners, Excel Realty Advisors, First American Title Insurance Company of New York, Gemini Real Estate Advisors, GVA Williams, Hal Fettner, Durst Fettner Residential, Herrick Feinstein, LLP, Helmsley Spear, Jackson Development Group, James D. Kuhn Real Estate Institute at Syracuse University, James Orphanides, John Katzimatidis, Massey Knackle Realty Services, Madison Realty Capital, Marcus and Millichap, M&T Bank, Meridian Capital Group, Newmark Knight Frank, Muss Development, Palin Enterprises, Rosenthal and Rosenthal, Signature Bank, Sterling and Sterling, Stephen Napolitano, Stonehenge Partners, Studley, the Moynihan Group.
Hello, my name is Michael Stoller. Everybody has this desire to own a piece of property. Everybody really would love to own a piece of the Chrysler building, a piece of an apartment house, and you can buy it. People can own it via something called REIT stocks. You can own it as an individual stock. You can buy it as a fund of stocks. And today, people really don't know enough about REITs. So I've assembled the gurus of the REIT world who are going to tell us a little bit about REITs and where they stand in this miserable credit crisis and the economy. My guests today include Carol Lee Burrows of Madison Square Investors, John Shea of Conan Steers, Andrew Calderwood of Perennial, and last but not least, Tony Pallone of J.P. Morgan. So, Tony, since you helped me coordinate the show today, what's the status of REITs? Would you explain to the layman who really doesn't understand what a real estate investment trust is, what it is?
Well, a REIT is really no different than any other company, in which you have a collection of real estate assets and a management team and a board and a strategy to go out and own and operate these assets as profitably as possible, and they happen to be public companies, so investors could go out and buy shares in them like any other company.
But a REIT, under law, is supposed to distribute 85% of their earnings, correct?
About 90% of taxable net income, that's right.
Right, and this year, some of the REITs have decided, like Vornado, one of the largest REITs who've been on my show, decided as opposed to give the cash, they gave some stock. Why'd they do that? Anyone, Tony, anyone else?
They
Andrew?
need capital. I mean, they gave 60% of their dividend in stock. They're going to save themselves $400 million. But I think as many people in the markets realize, the credit crisis hasn't really abated. And certainly for commercial real estate, it's going to get tighter as many of these existing loans that they have come due through 2011. So hoarding capital now will give them the ability to deal with likely more equity required when they come to refinance.
Oh, we were saying prior to the show, I'm not sure if it was Caroline or somebody else, we were saying that Vornado has so much money. They have so much capital. They're probably cash is king with them. And part of the reason is, why do you think they're holding all this capital, John?
Well, Vornado needs capital. Let's be honest. The world needs more capital in general, okay? And REIT stocks today, when you look at, frankly, the cash flow performance, the office buildings they own, the malls they own, the hotels they own, et cetera. Frankly,
Vornado owns hotel.
Okay. They own the future. They own a hotel with a big future. Frankly, look, cash flows are declining. It's a recession, so obviously cash flows are declining. REIT stocks aren't necessarily down because the real estate market is crashing. So why are REITs down? Because people are concerned about credit, okay?
Are REITs down? I mean, I remember sitting with your colleague a couple of years ago when it was everything is beautiful and the REIT world was great and all the REITs had gone up, everything. It was the greatest thing to invest in REITs. Sure. I mean, Marty said it, everybody, because it was the flavor of the year. It wasn't the favor of the week, it was the flavor of the year. REITs last year did as bad as the Dow Jones. I mean, this year, Tony, you said to me yesterday, REITs are down, what, 17%?
Yeah, about that.
So Dow Jones is how much is the Dow now? 12, 13?
Yeah.
So it's even worse. And what we were saying the other day, and I was at your conference the other day, REITs are more volatile than anything else today. Why is there so much volatility today?
Well, REITs lead the real estate market, just like the stock market bottoms before the economy does. REITs will bottom before the real estate market does. And I think what the REITs are pricing in is the distress that's coming in the real estate market.
So you're saying there's distress going to happen in the real estate market? Would you say that some of the REITs who have bought real estate may see the gloom because they can't refinance?
They may see the gloom because they can't refinance. However, the REIT stocks are going to price in the gloom in the entire real estate market. It's the industry in which they operate, and it will impact their ability to get financing, or at least how much they can get for the bank. So if you look at the loan-to-value ratios that banks are willing to lend at, it's really based on what they value the real estate to be. And so if the private market is selling at distressed levels, the amount of money that they may actually get from the banks could be a lot less than what they think they should get.
I think the bigger problem is that nobody, including the REITs, nor the appraisers, really understand what the value is today because there have been so few trades. So here, here's the situation. We, New York City and the tri-state region, have a number of really good REIT companies, different categories. This is not any investment advice or any opinion here is just to talk about. I mean, we have Vornado, we have McCallie, we have SL Green, we have Tangers, we have Alexandria's coming in over here. We have a variety. We have General Growth. Forget that. We can say the end of that. But we have a variety of these companies. Now, the biggest problem that one might perceive is Tony. SL Green. SL Green used to be a B player. They bought these B and C buildings. They made a lot of money with them. They bought them for $70. They sold them. And then all of a sudden, SL Green does what? And today they released their numbers. What they do? They became an A player? They wanted to go into the majors?
Well, they did a lot of transactions, and they did them on the way up. And when the dust has settled here, the company's got a lot more leverage than it appeared that they did when times were good. And it's going to take them a number of years, hopefully, to work through that and survive this downturn.
So what happens, your office is in the J.P. Morgan college campus, I'd say, on Park Avenue, that complex over there. You guys own the property. You bought Bear Stearns for next to nothing. You own the other building. You have this. What happens in that neighborhood that there are companies like Brookfield, Boston Properties, SL Green, who own real estate in New York City, where they projected, they may have bought a building, or they projected, even Mort, Mort, when he bought Boston, when he and the Saudis and the rest of the group bought the GM building, they thought they were going to get $150 a foot. April was then. We're in February now, so what's going to happen?
Well, I think you have to look at the REIT's capital structures versus what was happening in the private market. And while there's been a lot of volatility with the REIT stocks, I still think that these companies will generally be survivors. So whereas a typical private investor during the bull market was buying buildings with 70, 80% plus leverage, the REITs were running at 50%.
I'm in agreement. Every one of those REITs that I just mentioned, I think, are great. I think they're not overly leveraged and they're fine. The bigger problem that they may have is that the rents that they had projected may never be realized in the next 2 to 3 years. I mean, that's the bigger question.
Rents will go down 35 to 40%.
Right. I mean, you
Easily.
got to look at Boston. I mean, Mort was very bright when he sold the building, in Times Square. Did well. Market is slowly down. It's not the best market. I still think GM building is still a great building. It is the building that will keep the rent at a certain dollar point. But Andrew, you said to me prior to the show, what's rents in Park Avenue?
You can get sublease space for 60 a square foot. I think when Mort did buy the GM building, they at least penciled in waiting until 2020 to obtain some of those very high rents. So we'll give them a little bit of the benefit of the doubt for rents.
For Mort, I'll give him more than the
changing.
benefit of the doubt. There's no question.
Changing between now and then.
But your office is in Stanford. What's happening there?
14% vacancy. It's expected to be at 18% by the end of the year. And New York City at the moment is 8, expected to be 12. I think we're on a path of both price discovery, and people aren't really sure what's going to happen in the next 12 months. They know the direction, and so that makes it very difficult to model cash flows. But that said, we can kind of take a worst case scenario, and it doesn't look particularly good from an equity investor's point of view, which is why we see stock prices where they are. That's effectively what they're discounting.
I
at the
mean,
moment.
REITs went down 37% last year. I mean, I'm not an economist, and none of you are economists either. And you have the apple, so I don't have my crystal ball over here. How much could you see REITs going down this year? Any idea? I mean, it's too soon. We're in the first inning. I mean,
Yeah, we think they could take another 20% plus hit. Realistically, it's not out of the cards. The group is still trading at 11 times cash flow, and as we just talked about, there's a lot of risk to the cash flows coming down. So the question is, the REIT stocks are coming in, and how do you get them moving up again? You need to attract investors to the group, and that's a challenge right now because investors in these stocks, or potential investors in these stocks, see the multiples that may not necessarily reflect a lot of value. They think there's earnings risk due to the underlying real estate fundamentals, and real estate tends to lag.
but we have, they're like the apples I have. There are really 4 classes of real estate types of entities. We have office, residential, retail, and industrial. In the tri-state region, we have all 4 of them. Office is probably one of the larger prevalence numbers. Apartments. What's your thought about the REITs who own apartments? We have Equity, who has a lot of apartments. We have, Archstone is no longer a REIT, but you have AMCO, who owns apartments. And in reality, I'd worry about them because they bought a lot of apartments that are very old and are, in neighborhoods which you really have to hope that they're going to do well. In a boom time, they did great, but now somebody can move to a different neighborhood. What's your thought of the apartment REITs?
Well, so you got a couple of different trends. So we have a lot of job losses. Obviously, that's bad for just the amount of households that we have out there, okay? And whenever you have that, you have people that hunker down, move back with mom, 2 people, 5 people move into a studio, whatever the case may be.
Tony just put up his apartment.
So you have that going for you, which is obviously a lot of job losses. The only thing offsetting that is, unfortunately, when consumer confidence is low, no one's going to buy a house. People hunker down, they stay in their apartment, they keep paying their rent. Okay, so that's why I would almost say the $6,000 rent EQR portfolio, I'm a lot more worried about that than I'd be about the $3,000 Aimco portfolio. People are hunkering down. Everyone's trading down in everything they do.
So basically what I hear from you is that you're a little worried about the apartment portfolio.
I'm worried about the apartment portfolios overall, but definitely the higher price points.
Carolee?
As far as apartments goes, I think it's the one property type where you at least have the pros and cons balancing each other out. Like John mentioned, people stay in their apartments longer. Even if they can afford a house and affordability comes down, it's like an insurance policy. To buy a house, you have to put down capital. Are you really going to put down your capital and perhaps lose 50% of it if the real estate market is going down?
Prior to the show, we were talking about debt, and we were talking about the apartment world, and we mentioned Fannie and Freddie. Fannie and Freddie, which the government service agencies, which are now owned by the government, completely owned by the government, that they provide financing. They provided a lot of financing for multifamily. They're supposed to provide financing for affordable multifamily. So now we have a situation where Equity, who owns the entire West Side Trump portfolio, what happens over there? You're talking that their rents are going to go down.
Sure.
What happens if they have the refinancing risk?
It's not in the cards now, but I do think we may come to a point in the future where when Fannie and Freddie are restructured, in the same way that we have conforming and jumbo mortgages, I think we might still have multifamily financing, but it'll only be for
truly affordable.
Exactly. And so for Avalon Bay, Equity Residential, Archstone, for certain, frankly, it's not serving the affordable housing mandate. So I think you might still see it to finance Aimco or other certain price points, but I think you might. We don't know. Currently, they're financing everybody.
Okay, so now we know that December the retail sales were abomination. What's your thoughts about the retail world? We were talking before about Tanger's, the outlet king. They have in Riverhead, and then they opened up in Deer Park this year. What's your thoughts about companies like Tanger's or other retailers? Not retailers, REITs who own real estate that are leased to retailers.
Well, I think as far as Tanger goes, you've got a company that at least is not going to see as many bankruptcies and also has the price-conscious consumer going for it as well. A lot of the other retailers are starting to face the bankruptcies. I mean, a lot of the other retail REITs are starting to face bankruptcies with the retailers. And you've seen the fundamentals of their properties decline for the past couple of years in the nation overall. So I think retail is going to struggle, and there's going to be a problem with a lot of the retailers.
Tony, any thoughts?
We like Tanger because you do have a less levered balance sheet that takes some of this liquidity risk that we're talking about off the table with the name, and you're in a slightly more defensive part of the retail strata, which should help you out in a downturn. It's not to say their business is going to be great. I think it's their second largest tenant, Phillips Van Heusen, just announced a number of store closings.
See, I was just thinking about that now. Phillips Van Heusen, through all of their others, Bass and all the other Van Heusen and the other brands, they occupy in certain of the Tanger centers between 10 to 15% of the space in a variety of stores. If a Van Heusen goes bankrupt, I mean, they're not at the point right now, that could truly have a major effect on an outlet center like a Tanger or even a Simon on their luxury.
It could, but what you have to bank on is that even in a bankruptcy or in a situation where the retailers are undergoing a stressful situation, they're going to want to keep their profitable stores open. So we tend to lean towards the REITs that have more productive centers in the portfolio, and Tanger's is a good portfolio where if you're going to have a retailer pick where they want to be located, chances are they're going to want to be in one of those centers than another one.
What about, in the tri-state region, we have gigantic centers in Westchester, New Jersey, Stamford, and other markets. Some of them are owned by REITs. Aren't they owned by Simon and other REITs?
Right, and I think Tony made a very good point, particularly with Tanger, the cost of occupancy is around 8%, which is a little over half of what it might be in one of the major malls. In the major malls, you of course have issues, but you have many publicly traded companies, relatively much better capitalized than some of the small operators in shopping centers and occupying that space. And so the likelihood of a lot of it going dark is lower. Now, I won't say we're clearly going to have bankruptcies and some of the space is going to go dark, but on a relative basis versus some of maybe the strip malls.
32,000 employees from Circuit City has a large effect on a number of REITs, in a variety of ways, One Liberty and other situation. Kmart is still in the crapper. I mean, I still have no idea why Lambert owns it anymore. He's not a retailer. He doesn't care to be a retailer. Home Depot announced that they're closing their Expo stores, and they're trying to avoid many leases. So I don't know about the retail spectrum today.
It's relative as well. I mean, I agree with you. Retail is a tough place to be at the moment, but on a relative basis, I think the Tangers and the high-end malls are probably going to hold up better with occupancy and rents than
Now,
some of the
what
strip
about
centers.
industrial? I mean, people don't realize how much industrial there is in the region because of the New Jersey market. What's your thoughts about the industrial? Anybody want to?
Well, so historically, we would normally think, oh, industrial is a little bit more defensive than the other property types. I tend to not believe that this time around. Frankly, every national industrial owner for the last 20 years has built their business around this idea that imports go up every year for 20 straight years, except for the last 9 months, where it's been an absolute disaster. Okay, we're going to start exporting more in the next few years. But for the most part, most owners aren't geared to benefit from exports. They're geared to benefit from, frankly, imports. Okay, and so I think, excuse me, I think of the idea of industrial is not retail, but at the end of the day, it is consumption. It is the flow of goods.
And I think, John, what you're bringing out is even better. I know a number of people who own a large amount of industrial, and they depend on the Kmarts who are using their regional warehouses or a distribution facility. And, one of them was going to buy a property up in Albany a couple years ago, and he said to me, oh, it's Sam Goody. I said, don't you get into it. Sam Goody went out of business. And, take the same situation of right now, people think of Circuit City of the retail stores. Yeah. It's more of there are distribution facilities around the country that are going to be hurt because of this situation, which are owned by REITs, like One Liberty and some others over there.
Yeah, and a lot of what the industrial REITs did was not just, you don't just have the risk of what's happening to the distribution channel and the pullback in retail and the economy, but a lot of these companies like a Prologis or an A&B really juiced their business model by going into merchant building, booking land sale gains, build-to-suit gains, going to the fund business, where it just added another layer of complexity and risk to their business, which is now unwinding.
We were talking before because you follow a company who's a little stranger, but a very interesting company, Alexandria. Can you tell my guests and my audience about what they are?
Alexandria Real Estate Equities is an office REIT that builds lab space and office space for large pharma, startup biotech companies. The space is relatively high-tech. There's a lot of accoutrements that these companies need. They develop these life science clusters around the world. They've got a large project in New York, the East River Science Park, which they are developing in cooperation with the City of New York and New York University, and a couple of the hospitals over there.
I think it's a great location, for that type of business over there. What about now? We've gone to the food chain. I want to get back to the office market. How tough do you think it's going to be, the suburban office market? We spoke about the New York City office market. What do you see about the suburban? You have an office in Stamford. I mean, you follow companies with suburban markets. You all do. What's your thought about the suburban office market, Tony?
I think it's going to be challenging for these companies because unlike, say, New York, where most of the public companies that were doing business or are doing business here had a 50% mark-to-market in their rents. So you've got a lot of cushion to burn through before you start to have rent roll downs and impact on your cash flow, whereas the guys in the suburbs really haven't had that. If they had 5 to 10%, that was good. So with the pullback in the economy, they're going to see a decent hit to their cash flows. But a key difference is those stocks have been priced accordingly in many instances.
A comment that always said many companies moved to Jersey City and Hoboken because it was the lower cost alternative. What about companies like Brookfield today, who has a potential major exposure because Merrill Lynch is going to move out of Lower Manhattan? They're going to close up, and AIG is out of business. They don't need the space, and a number of other companies, and Citigroup and all the rest. What's going to happen to it? What's your thoughts about a Brookfield? It's a great company, but maybe a little hard in this market.
There are definitely leasing challenges downtown, and as you pointed out, there's a lot of space coming back that doesn't look like it has any obvious tenants right now as we stand. And comparing it to suburban, I think one of the things that has surprised people in New York City is the fact that just the speed at which we've seen vacancy increase and rents decrease Tony did make a very good point about the fact that we had the mark-to-market cushion, but as we approach a point probably in 09, 010 when we're 10 years on from peak rents from the year 2000, the last peak of the business cycle, I think we're at a point now, at least in New York City, particularly downtown, where we'll start to see those NOI roll downs, and certainly from the leasing perspective, a lot of the space may go vacant, and that's going to be very tough on cash flows.
But would you say that perhaps the biggest problem facing REITs in general in the region is the refinance risk? You know, mortgages coming due, the fact that there's no more collateralized mortgage backed, that banks no longer write a slug of a $400 million mortgage. They have to go around to everybody to get a deal done.
It's a significant issue for REITs as it is for commercial real estate overall, but I would still argue that it's less of an issue for
because
REITs
they
than
weren't
it
as
is.
leveraged.
They weren't as leveraged.
As leveraged as that.
But it's still an issue.
It's the, at the end of the day, it's the threshold issue for the REIT business. You know, when I think about
So you believe that the refinance risk is truly the threshold?
Yeah, exactly. Because, you know, look, we talked about our expectations for REITs in 2009. You said that they traded an 11 times multiple, and you said, well, but cash flows could go down even worse than that. And I agree with that. They could go down worse than that. The S&P trades at 15 times cash flow. Now, I'm pretty sure that we may not be able to know exactly what REIT cash flows will do, but we can be a heck of a lot more sure of that number than we can about the S&P. The S&P can go down 10, 15, 20. And so it's not about the buildings. It's about the credit.
Money.
Exactly.
Okay.
It's about the credit. And so the one thing I'd say about suburban office, frankly, smaller is better. It's a lot easier to get a $40 million loan on some building somewhere.
I agree.
Than a $400 million
In order to really gain insight on REITs, I can't do it in half an hour. So hopefully later in the season, you'll come back and we'll talk more about REITs. I'd like to thank Caroline Burrows, John Shea, Andrew Calderwood, and Tony Pallone for being here. Next week, we have the guys talking about the truth about the office market. See you next week.
Major funding for these programs is provided by grants from Capital One Bank and Perfect Building Maintenance, Murray Hill Properties, SJP Properties, Cushman & Wakefield, Greenberg Traurig, LLP, New York Community Bank, Bank of America, Kilroy Metal Products, New York's Window Company. Additional funding is provided by Akron Gold Brothers, LLC, Briarwood Organization, C.B. Richard Ellis, City Investment Fund, Essex Capital Partners, Excel Realty Advisors, First American Title Insurance Company of New York, Gemini Real Estate Advisors, GVA Williams, Hal Fettner, Durst Fettner Residential, Herrick Feinstein, LLP, Helmsley Spear, Jackson Development Group, James D. Kuhn Real Estate Institute at Syracuse University, James Orphanides, John Katzimatidis, Massey Knackle Realty Services, Madison Realty Capital, Marcus and Millichap, M&T Bank, Meridian Capital Group, Newmark Knight Frank, Muss Development, Palin Enterprises, Rosenthal and Rosenthal, Signature Bank, Sterling and Sterling, Stephen Napolitano, Stonehenge Partners, Studley, the Moynihan Group.